I'm Steve from Clearly Training, and this is a video all about the profit and loss account. So here at Clearly Training, we try and make finance accessible and easy for non-accountants. And this one is all about the profit and loss account. If you want to know anything else about accounts or financial statements, then have a look at our website, clearlytraining.co.uk, which is on all of the slides, or have a look in the bio and have a look at our Udemy page where we have courses, paid for courses that you can look at that are full and comprehensive analyses of the financial statements. This one, though, is all about the profit and loss account, or as it's also known, the income statement, just to give you a little bit of a heads up on what goes into a profit and loss account, what it tells you, what the different sections are all about. So let's go and have a look at that. So let's have a look at a little bit of detail on the profit and loss account. First of all, profit and loss account is our statement of performance. And we often say that the profit and loss account is like a video in that it shows us what's happened over a full period of time. So a profit and loss account could be over any period that you choose, although sometimes you are made to produce your profit and loss account over a full year. So in the UK, for example, you have to produce a profit and loss account for your accounting year, and you choose whatever accounting year you want, but every year you've got to submit that. If you're a limited company, you have to submit it to Companies House. If you're not a limited company, you'll have to submit your profits to the tax authorities. So you have to produce a profit and loss account legally in the UK over a year, and that year can be any year that you choose. So in other words, it can be a period of 1st of January through to the 31st of December if you want to have a calendar year, or maybe the 1st of April through to the next 31st of March, or the 1st of June through to the next 31st of May, whatever you choose. In these examples, I'm going to use a calendar year just to illustrate things. So I'm going to assume our accounting year starts on the 1st of January and ends on the 31st of December. So we're going to use an accounting year. One other thing, if you want to, any business can choose to do a profit and loss account over a shorter period. So a lot of businesses decide, oh, well, we're going to track our profit and loss performance over, let's say, each month. So over every month, you can do your profit and loss account internally without any legal requirements to do so. So profit and loss accounts are over a period. Let's use the example of a year. So our profit and loss account tracks our performance over a full year, from the 1st of January right the way through to the 31st of December. And it tells us how we've performed. And by performance, what we mean is what income and expenses have we had over that period. So let's have a look at a little bit more about income, and then we'll have a look at expenses. So let's have a look at income. First thing is, income can have many different names. So the two most common names are turnover, which is a more old-fashioned term, and revenue, which is the more current term. But you could see either of those terms at the top of the profit and loss account. Other organizations can choose different names, different words for that income. So you could have sales, very simple term, or fees. If you were, let's say, a professional services business, you might use the term fees. But that's the term that goes at the top of the profit and loss account, whatever your income is, whatever word you want to use. And then what we show below that is we show what's been deducted from that income. So we show the expenses. And what we do with expenses is we normally split them into at least two categories. So on a legal profit and loss account, for example, you will see two clear categories. First of all, the direct costs, or as they're also known, the cost of sales. So the direct costs are the costs that directly create the product or service that you're selling. Whatever it is that you're selling, anything that's directly involved in that will go in the direct costs. So I'm going to use an example to illustrate direct costs. I'm going to use an example of somebody who's manufacturing tables. So this is a very simple manufacturing business. This is a person that purchases pieces of wood, cuts them down, cuts them to size, and then attaches metal legs, which are also purchased. So it's a very simple manufacturing operation. Now, anything that's directly involved in making those tables will be in our direct costs or cost of sales line. So that will include the cost of the wood, the cost of the legs, and then there'll be some other things as well, won't there? So what about the cost of cutting it to size? Anything that's involved in cutting it to size will be included. What about the cost of the person who's actually making it? What about their wages? That will be a direct cost as well. Yeah, so those are the key direct costs. any machinery we use to make it, any costs of using the machinery, they will be direct costs. So that's our first major category of costs, our direct costs. The next category is known as indirect costs, or also overheads. So overheads are any support costs, really costs that are used for the administration or selling stroke distribution of the product or service that you're selling. So things that would be included in our table manufacturers costs would be things like, well, any staff that are paid to distribute, to deliver the products. Let's say we had a van that we use to deliver the products, any fuel to go in the van, any running costs, maybe we're leasing the van, those costs would go in there. Any costs to do with anything to do with administration, so if we had to buy computers, any costs of running the computer in order to help us administer the business, those costs. What about paying our accountant? The cost of paying our accountant to help do our accounts, that would be an overhead cost. So there's loads of things that would go in that overhead line. So that's our indirect costs or overhead. So that's our second category of costs. Now I'm going to move on and have a look at an overview of a profit and loss account and add some more things in there. So let's have a look at that now. What I want to build up on screen now is a picture of the profit and loss account and some reminders of those things that I told you about on the previous slide. I also want to add some extra costs at the bottom, and you'll see why as we go through. So we're going to start off with the sales or income or turnover or revenue, that first line, our income line there at the top, sales, and then we're going to deduct the direct costs from that. So remember, put a little box up here, the direct costs are any costs that directly relate to the production, manufacture, or creation of the product or service that we are selling. Yeah. Then what we do in the profit and loss account, so here's a little extra thing, is we do a little subtotal. So we set the sales figure and we deduct the direct costs or cost of sales. Then we do a little subtotal, and that subtotal is called the gross profit. Gross means big, basically. The big profit. It's the profit before we deduct the overheads. Why do we have that line? Well, it's really important for business people to make sure that if they're buying something for £10, that they can sell it for more than £10. So the basic cost of either buying the goods in or the basic cost of manufacturing the goods, that they are exceeded by the sales price. So if you buy something for £10 and you sell it for 15, let's say, then you will have made a £5 gross profit on that sale. So if you were just a very simple business buying something in for £10, selling it for 15, then you would make a gross profit of £5 on that sale. Yeah. And then what you would have to do, of course, is you'd have to keep your overhead costs below £5 to make sure you made, well, we'll see what it's called. It's actually called an operating profit. But you want to make a gross profit. Any business that's not making a gross profit doesn't have much chance of success. So that's the gross profit. Then we take the overheads, and remember the overheads are all of the things to support the business in terms of the administration costs, the distribution costs, and so on of running that business. And once we take off the overheads, we then have another subtotal, and that's known as the operating profit. So that's the profit from running our business after all of the operating costs, the direct costs and the overheads. Are we actually running this business at a profit? Does this business work as a business? Now, the operating profit's also got another name. It's known as the EBIT. That's an acronym, and EBIT stands for the earnings before interest and tax. EBIT, earnings before interest and tax. Earnings being the earnings of the shareholders. What are the earnings of the shareholders before deducting interest and tax? Because the next two lines we see are lines to show us deducting, first of all, interest and then tax. You see, when I started talking about the profit and loss account, I ignored these two items at the first instance because, of course, they're to do with things outside of your normal trading operations. You'll be paying interest if you've had to borrow some money in order to get your business going. Yeah, some businesses do have to borrow money, some businesses don't. Some businesses might be run because the owner, the shareholder, has put their own money into the business. Some might be run by borrowing money from banks and other lenders. Okay, so we might have interest to deduct. And the other thing we might have to deduct down there is the tax, because of course, if you're making money, you'll be paying tax. It's a good thing to pay tax because it means that you're making money, you're making a profit. So the interest has to be deducted and the tax before we get the earnings, because the earnings, the figure at the bottom, that total at the bottom, that earnings figure is the earnings for the owners of the business. And if this is a limited company, then the owners of the business will be the shareholders of the business. So the earnings are at the bottom. The figure at the bottom has other names as well. It can also be called the net profit, for example, but it's the figure at the bottom after everything's been deducted, not only the operating expenses, but also the interest and the tax. And then what you can do with that earnings, once you've worked out how much you've earned, then you've got a decision. If you're running the business, your decision is, do I, first of all, keep those earnings in the business? Do I retain those earnings? Why would I want to do that? Well, because I can use that in order to help me get the business to grow. Or I can pay those earnings to the owners. And of course, if the owners are shareholders, then a payment to the shareholders is known as a dividend payment. Okay. And what actually happens in practice is that the people running the business will do part of each. So they'll give a little bit to the shareholders as dividend, and they'll keep some in the business to help the business grow, because of course it's in the shareholders' interest if the business can expand in the future. So there you go. That's a little overview of what the profit and loss account looks like. Now, something I need to mention at this stage is that when you prepare a profit and loss account, that statement that shows us the performance of the organization over our period of time, then that profit and loss account is prepared using something really, really important called the accruals principle. The accruals principle. And the accruals principle is the way the accountant thinks when he or she is deciding what to put into that profit and loss account. So how do we create the sales figure, the income figure? Well, we put the income in the profit and loss account that has been earned in the period. So remember, my example is a period starting on the 1st of January and ending on the 31st of December. So if we're doing the profit and loss account for the accounting year, then any income that's been earned in that year will go in that top sales revenue turnover line. Anything that's been earned in the year. And conversely, in the expenses line, so that's the direct costs and the overheads, anything that goes in that expenses line will have been incurred in the year. Now, the accruals principle is really, really important. We've got a full video, by the way, on our full Finance for Non-Finance People series, explaining to you how the accruals principle works, giving you a nice practical example. Not going to go into the detail here, but it's very important for you to understand that a profit and loss account doesn't show, for example, a lot of people think the profit and loss account shows the income being the cash received in the year. It's not the cash we receive in the year that's the income. It's what we've earned in the year. And a lot of people think that what goes in the expenses in a profit and loss account is what we've paid for in the year. It's not what we've paid for in the year, it's what's been incurred in the year. And that term incurred and the other one earned are really crucial. They show us how the accountant thinks. It's very important that you appreciate that what goes in the profit and loss account is items that are created, derived using that accruals principle. So as I say, if you want more information on that, have a look at our full Finance for Non-Finance People series on Udemy or on our website. Okay, let's move on. I just want to finish with some other names for the profit and loss account. So let's have a look at a few just quickly. So P&L is an obvious one. It's an abbreviation. People talk about the P&L, the profit and loss account. There's also a legal term that is used in the UK. It's also used in the US. In fact, it's used all over the world. And it is the term income statement. So income statement, if you look at a set of statutory accounts, the ones that are sent to government, they will often use the term income statement as a header for the profit and loss account rather than using the term profit and loss account. But you're still looking at the same thing. The income statement is just another name for the profit and loss account. Then there's the term management accounts that you come across. So when a business produces its own internal set of accounts each month, what will usually be in that management accounts is just a profit and loss account. They'll show a profit and loss account each month of the year. They'll send that profit and loss account to their managers within the business, just so the managers can see how their departments or how their divisions are doing on a monthly basis and take any necessary action if things aren't going well to correct things. So the management accounts is a term used to describe the internally produced profit and loss accounts that are sent to managers. And the last two are really terms I've come across in the public sector. Again, these terms would be used as equivalents to management accounts in the private sector. So the income and expenditure account is one I've come across. That does what it says on the tin, if you like. It tells you the income and expenditure for a month or for 6 weeks or for a quarter or for a year within a public sector organisation. And the other one that I've come across in the NHS in the UK is the term budget report. So budget report is a monthly report that goes to managers in the NHS that shows them how well they're performing in terms of their income and expenditure for different parts within a hospital, let's say. So the budget report. All different terms, all mean basically the same thing. They all describe profit and loss accounts within different organizations and over different time periods. So there you go. That's our little run through the profit and loss account and what goes in the profit and loss account, and of course what's not in it. So the profit and loss account is our key statement to show the performance of the organization. If you want to know more about profit and loss accounts, if you want to know about balance sheets, if you want to know about cash flow statements, then check out our other stuff either by going to our website and looking at the online things that we do, or go to our Udemy page in the description below on this channel. Thank you for listening. I'm Steve from Clearly Training. Bye-bye.